Hi everyone, this is Iris.
And this is Ronnie.
And welcome to Prezi Corporation tutorial. We are about to discuss what is liquidation,
the types of liquidation,
the terms to remember,
and its accounting process.
What really is liquidation?
So a partnership is liquidated when its business operations are completely terminated or ended.
Or in other words, it is the termination of business operations.
There are two types of liquidation. The first is the lump sum or liquidation by totals, whereby the distribution of cash to the partners is done only after the NCA have been realized, the total amount of gain or loss on realization is known, and all liabilities have been paid.
Second is the piecemeal or liquidation by installment. Type of liquidation whereby assets are realized in piecemeal basis and cash is distributed to partners on a periodic basis as it becomes available. Terms to remember.
Realization.
Loss on realization.
Gain on realization.
Capital deficiency.
Deficient partner.
Insolvent partner.
Solvent partner.
Right of offset.
Restricted interest.
Free interest.
And partner's interest.
So how?
How is liquidation done?
First, conversion of assets into cash.
Then the payment of liabilities.
Lastly, the distribution of remaining cash among the partners. Sample problem. For a sample problem, we have the balances of Molina, We, and Pastor Fide as of November 30, 2016. Instructions. For each of the cases listed below, prepare a statement of liquidation assuming that cash is realized for the other asset as indicated in each case and that all available cash is immediately distributed to proper parties. You may take down the balances as a guide throughout the tutorial. Step-by-step process. Let us first discuss about lump sum liquidation. Basically, this is the overview of a liquidation schedule. Don't worry, it's not as complicated as it seems. We are going to show you how a liquidation schedule is done under 6 different cases. First case. Gain on realization, no capital deficiency. The non-cash assets were sold at $360,000. We have the following accounts to be considered. It is vital to include the profit or loss ratio on the statement as it is the basis for capital distribution. But take note that liquidation ratio must be used when given. For this tutorial, since no other ratio is provided, we will follow the PL ratio of 25%, 50%, and 25%. Next are the balance before liquidation. These are the balances that we have gathered from the sample balance sheet. Next is the sale of assets and the distribution of gain by which our non-cash assets were sold at $360,000. We now get the difference of the proceeds and book value of the NCA sold, that is $20,000. The gain is then distributed to their PL ratio, so we arrive with the following amounts. Molina, $5,000, we, $10,000, and Pastor Fide, $5,000. Always bear in mind that the assets must always be equal to liabilities. Next is the payment of liabilities. Cash is paid out to settle our liabilities, so then we get the balances of 268,000 cash, 0 non-cash assets, 0 liabilities, 13,000 we loan, 100,000 Molina capital, 70,000 we capital, and Pastor Fide capital of 85,000. Finally, the payment to partners comes next. Always remember that the goal of the liquidation process is to zero out the assets and distribute the cash settlement based on the partners' capital balances. And that's it. We're done for Case 1. Case 2. Loss on realization, no capital deficiency. Case 2 is basically the same as Case 1. The only difference is that instead of a gain, we have incurred a loss from selling the non-cash assets at 300,000. The same process applies for the distribution of loss among partners. But in this case, we deduct the distributed loss from their capital balances. So after selling the NCA and distributing the loss to each partner, we have the following balances. Then, payment of liabilities are made. Lastly, is the payment to partners. Now we move on to Case 3, loss on realization, capital deficiency, and right of offset. Let us assume that the non-cash assets are sold at a much lower price of 200,000. We still have the same PL ratio, 25% for Molina, 50% for we, and 25% for Pastor Fide. The balances before liquidation are as follows: cash, 20,000, non-cash assets, 340,000, we loan, 13,000, Molina capital, 95,000, we capital, 60,000, and Pastor Fide capital of 80,000. We then proceed to the sale of assets and distribution of loss. After which, payments of liabilities are made. The right of offset is likely applicable in this case since we has a deficit of 10,000, which will be deducted from his loan of 13,000. Case 4 is next. Loss on realization, capital deficiency, and deficient partner is solvent. The non-cash assets were sold at 150,000, but this time, the deficient partner is solvent. As a review, we know that a solvent partner is a partner whose personal assets are more than his personal liabilities. Following the same procedure, we came up with the following balances: cash, 58,000, NCA 0, liabilities 0, we loan 13,000, Molina capital 47,500, a deficit of 35,000 for we, and Pastor Fide capital of 32,500. We can see that we have a deficit of 22,000 for we. Since we is deficient yet solvent, he has to invest 22,000 into the partnership to offset his deficient capital. Just like in the previous case, we offset we's capital by crediting his loan of 13,000. The distribution of the loss on realization resulted in a debit balance in the capital of we that cannot be fully absorbed by his loan. We, the deficient partner, offsets his deficiency by making additional investment. By doing so, the partnership will satisfy all its liabilities, including each partner's liabilities. And now, we move on to Case 5, loss on realization, capital deficiency, and deficient partner is insolvent. In Case 5, again, the same initial procedure applies. However, the deficient partner is insolvent. As a review, an insolvent partner is a partner whose personal assets are less than his personal liabilities. During the process, we's capital resulted to a debit balance which cannot be fully absorbed by his loan. Failure of the deficient partner to cancel his deficiency is to be regarded as additional loss to the remaining partners using their profit or loss ratio. And now we move on to Case 6, loss on realization, capital deficiency, right of offset, and cash distributions. The other assets were sold for 150,000. Additional cash investments by deficient partner is to be made as second cash distribution to partners. All available cash is immediately distributed to partners, requiring a schedule to accompany the statement of liquidation. The schedule to accompany the statement of liquidation shows amounts to be paid to partners. Total partners' interest is reduced by the restricted interest for possible losses, in case the deficient partner fails to pay his deficiency. Restricted interest for possible losses shall continue up to the point when deficiencies or debit balances in capital are eliminated. When deficiencies are eliminated, balances shall be called free interest, amounts to be paid to partners to apply first on loan, then on capital.
The following was the condensed statement of financial position of Galvez, Ong, and Cresmundo as of December 31, 2015. Please take down notes the balances of each account for you to use it as a guide on this tutorial. On January, the non-cash assets with a book value of 350,000 was sold at 200,000. And in March, the non-cash assets with a book value of 250,000 was sold at 300,000. Installment using safe cash distribution. Galvez, Ong, and Cresmundo Statement of Liquidation, December 1 to 31, 2016. PL ratio, 30% for Galvez, 50% for Ong, and 20% for Cresmundo. Balances before liquidation are as follows. As stated, the first non-cash assets was sold at 200,000 with a loss of 150,000. The loss was divided to each partner through their PL ratio. Balances after the sale of assets and distribution of loss are as follows. Balances after the payment of liabilities are as follows. So before we'll proceed on the distribution of payments to partners, we'll first make the safe payment schedule. So this is how a safe payment schedule look like. First, we are going to plot the capital balances before cash distribution of each partner. Then we'll add the loan balance. Then we will have the total partner's interest. Then the restricted interest. From the total partner's interest, we will subtract the restricted interest. The amount of the partner's restricted interest are the product of the amount of unsold assets, which is 250,000 multiplied by the PL ratio of each partner. Then we have the free interest. However, partner Ong has a deficit of 20,000, and assuming that he is unable to pay his possible deficiency, and so Galvez and Cresmundo will share the loss. Then we have the cash distribution. After making the safe payment schedule, we will now distribute the payments to each partner. Then we will have the following balances. Next, we have the sale of the unsold NCA, so there is a gain from the sale of these assets, and these gains are to distribute to each partner using their respective PL ratio. Then we have the following balances. Then payment to partners are made. Installment using cash priority program. So the statement of liquidation that is used here is just the same on the statement of liquidation that was used in making the installment using the safe cash distribution. We have the same PL ratio, balances before liquidation, sale of assets and distribution of loss. We have the same balances after the sale of assets and distribution of loss. Then we make the same payment of liabilities. Then we have the same balances after the payment of liabilities. And so before we make the payments to partners, let's first make the cash priority program schedule. Installment using cash priority program. This is how a cash priority program schedule looks like. First, we plot the capital balances before cash distribution of each partner. Then we will add the loan balance. Then we will arrive to the total partners' interest of 220,000 for Galvez, 180,000 for Ong, and 110,000 for Cresmundo. Then the total partners' interest is to divide to the PL ratio of each partner to arrive at the maximum loss absorption of 733,333 for Galvez, 360,000 for Ong, and 550,000 for Cresmundo. Then we have the allocation 1. Since partner Galvez has the highest maximum loss absorption, we will subtract 183,333 on her balance so that she will have an equal balance with Cresmundo of 550,000. 183,333 is then multiplied to Galvez PL ratio to know the payment she will receive. As of the moment, Galvez and Cresmundo has the same balances of 550,000 and Ong of 360,000. So to equal the balance of Galvez, Ong, and Cresmundo, we will lessen an amount of 190,000 to Galvez and Cresmundo. The subtracted amount is then multiplied to Galvez and Cresmundo's PL ratio to know the payment they will receive. Finally, after making the CPP, we arrive at the payments to be distributed, which is 169,000 to Galvez and 76,000 to Cresmundo. After making the cash priority program schedule, we will now give the payments to each partners. Then we will arrive with the following balances. Then we will make the sale of unsold assets and the distribution of gain to each partner. Then the balances after the sale of assets and distribution of gain are as follows. Then payment to partners are made.